Hello and welcome to LAT's Weekly Market Insights. The economic calendar, alongside some eagerly anticipated earnings, dominated this week's market action. Super Thursday taking centre stage with the Bank of England and ECB both up with their rate decisions. On home soil, the Bank of England led the way and is now on the cusp of the fastest tightening of monetary policy since it gained independence in 1997, as it leads the way among many of the major central banks fighting inflation. The MPC voted to raise rates by 25 basis points to spot 5% as expected, but more importantly than this, 4 out of the 9 members pushed for a 50 basis point increase. The Bank of England will also start to unwind £895 billion of bond holdings it amassed over the past decade to stimulate the economy and money markets. We now see the benchmark interest rate rising to 1% by May, the threshold at which the central bank has said it could start shrinking its balance sheet. It is, however, overseas where we saw fireworks start to unfold. Christine Lagarde was next in the spotlight, and she did not disappoint. Previously in the week, we'd seen euro area inflation unexpectedly accelerated to a record in January, coming in at 5.1% year on year versus the expected 4.4%. However, worth noting that stripping out energy and other volatile components like food, core inflation was in fact down for 2.3% from last month's 2.6% reading. The European Central Bank and Christine Lagarde took a far more hawkish stance than expected and renewed its pledge to withdraw pandemic stimulus only gradually despite record inflation. However, source comments released shortly after the event suggest the bank is prepared for a potential March policy recalibration and that they agree it is sensible not to exclude a rate hike into 2022. Off the back of this, banks are rushing to adjust their forecasts. Goldman Sachs, Commerce Bank and Bank of America strategists are among those who have revised calls and predict the deposit rate will hit 0% in December. The ECB's key rate, of course, currently stands at a record low of negative spot 5%. If we come across to the charts, we can see the moves that were created, and it was euro-dollar which took centre stage. A big impulsive move higher in the euro off the back of the more hawkish tone, but great to see some technicals here also unfolding. The past 2 weeks we've seen euro-dollar weakness as dollar has strengthened off the back of again a more hawkish tone taken by Jerome Powell and the Federal Reserve. As we came down towards the lows, however, at the start of the week and markets started to price in the expectation for this more hawkish ECB, we saw this lower high broken before going on to be retested after a succession of higher lows. That prompted the rally through the start of the week before we took a little bit of a pause. Now that pause put in a low on Wednesday before retesting that low at the data release on Thursday. That also fell in line nicely with this monthly pivot point, the 50-period moving average, also here acting as dynamic support. And that moving average had been previously respected. We saw it multiple times as resistance on our way down through here. So yes, fundamentally driven, but some beautiful technical opportunities, and certainly buying the rumour at the start of the week was an excellent trade, seeing this huge rally now that's followed through in euro-dollar. Cable, slightly less dramatic, but nonetheless followed a similar theme. We saw cable again start to price in the expectation for that more hawkish Bank of England and the uptrend unfolding through the week. Again, yesterday we saw the move higher, however not quite as aggressive or as accelerated, largely far more expected from the Bank of England. Governor Bailey being very clear and explicit in the coming over the previous weeks of expectations, and markets largely already priced in that rate hike. As of today, we've seen sterling just settle back, trapped now between a range as we come through towards non-farm payrolls, which of course the dollar will start to take centre stage again as we come to close out the week. Looking to elsewhere and looking towards the tech sector, it has not been a good week for some of the world tech giants. Facebook's parent company, Meta Platform, plunged 26% on Wednesday, which also had a knock-on effect, taking Nasdaq with it. Now, unfortunately for Mark Zuckerberg, he has now gone on to make market history as he goes on to wipe out 250 billion of market value in an instant. And that now unfortunately takes the record. We can see it here, 252 billion. The record previously held by Apple, which was set back in 2020, wiping $180 billion of market value. As we come across to the charts here, we can see that drop in Facebook. It was an aggressive move. We're looking here at the weekly chart, but what's curious to see now is, yes, it's been an aggressive move lower, but never rule Mark Zuckerberg off. We've seen numerous sell-offs, not to this extent, but aggressive moves previously, and the bounce back has always come in. And we have technical levels here now. We've got a 200 period moving average, a 61% fib retracement, and the previous highs that were placed at 2018 and 2020. So don't rule this out just yet. Key support levels coming in here, and we'll look to see how it develops, but certainly a rough week for Mark Zuckerberg. Now the impact from that was also then felt through the tech sector as a whole. The Nasdaq taking a hit, and interesting technicals again here for the Nasdaq. And we can see the longer term view here on the daily. The uptrend has been broken. We've seen a move below the 200 period moving average, and more significantly than anything, it's just a break of this previous higher low that we can see here. Technically ending this uptrend, having failed up through this double top formation that we had seen unfold over the past month or so. As we make our way down into the lower time frames and we drop down into the 4-hour chart, we can start to see some technical adherence. We see a beautiful downtrend being well respected. Now we had strong selling. See this arrow just marking, we took these lows out here, and it was really aggressive selling back on the 20th of January. The little relief rally that we saw took us back up towards those highs before then the turnaround and the move back lower as we hit that key resistance level. Now this downtrend technically here therefore still in play, and we can see that more so if we continue down into those lower time frames, drop down into a 30-minute chart here. We can start to see the turnaround from that level, round numbers being really well respected, but lower highs, lower lows on a more intraday time frame here. Key resistance again holding. The red box suggests is the knock-on effect after those Facebook earnings were released. So you can see that big drop lower here in the Nasdaq, which has taken all the indexes with them for the same ride. And we're sat in around this 14,800 region and seeing some negativity flow through again this morning. There was a bounce back. Okay, that negativity did still see some strong buying in here as we hit that 14,500 region and testing these previous lows set back on the 31st of January. But certainly a tough week for big tech, tough week for Facebook. However, the one exception to that is Google. Let's just bring up that chart. Alphabet's stock split has aimed to be bringing Google shares to the masses. The move would drop the share price to about $140 from almost $3,000. The split could help Alphabet gain entry to the Dow Industrial Average. Now, the company said late on Tuesday it will increase its outstanding shares by a 20-to-1 ratio, aiming to entice the numerous small investors who have flocked to the stock market during the pandemic. The shares jumped 10% in the US pre-market trading on Wednesday and were set to surpass their record high reached last November. Now you can see that move higher through here, and we have held firm at this big round number, that 3,000 marker, hit resistance. It's held that resistance, and as of yet, just taken a pause and a bit of a breather. So we'll be looking to see if Google can see a move through these highs. Before looking to get involved, we'd like to see the extreme high here taken out to confirm that this is a confirmed move to the top side. So not all bad news. Jeff Bezos has extended his wealth and added another 25 billion on top. So a rough week for Zuckerberg, a positive week here for Alphabet and Google, and Jeff Bezos, who also reports some positive earnings. Focus for today now will shift towards non-farm payrolls, which are due out at 1:30. Expectations is for a reduction to 150,000, and dollar will once again start to take centre stage as we move beyond Christine Lagarde's Euro news and, of course, Governor Bailey's sterling news. Next week, as we come across to the economic calendar, far lighter on the news front. We'll pull up next week. It will be inflation that takes centre stage. out of the US. GDP on Friday. Beyond that, pretty quiet. So an action-packed week has come and gone. Some dramatic moves in the market. I hope those of you trading it managed to capitalize on some euro strength, some sterling strength, and perhaps were able to grab some short positions in those indice markets. Okay, that is all from us for this week. However, please do join us same time next week for another weekly market insights.